This is episode 257 of Zen and the Art of Real Estate Investing with my guest, Austin Masket. Austin is a fund manager, founder, and the chief investment officer of Riverly Capital. He brought over $1 billion in transactions from his former real estate positions to that place. Austin, welcome to the show.
Hi, Jonathan. Thanks for having me.
Yeah, excited to talk a little multifamily and syndications with you and get your background. I know you started as a broker. Was that when you were interested in real estate, or were you interested when you were younger as a kid in real estate?
So I kind of grew up in a real estate family. Remember very young going to, showings, trying to rent single family homes with mom and dad.
Nice.
So did a lot of that. Out of school, just kind of clicked to be able to hop into brokerage. Started at Marcus Millichap, like so many of us do, and really that really gave me the financial footing to get into syndication and be an investment director or portfolio manager for family offices.
Yeah, were your parents brokers or agents, or were they investors, or both?
Investors, kind of smaller investors in Southern California.
Yeah.
Did well there. So that's where I grew up, but been in Denver since 2007.
Yeah, when you were, because I grew up with a dad who dragged me to literally everything as well. Were you interested in it, or it just become something that you kind of learned through osmosis? Because I always kind of had fun, but some days I just would rather go play basketball. But then later I realized, wow, just being there, I learned a lot, tenant relationships, landlording, all of those things. How was it for you?
Yeah, it was similar. I think no kid loves to go to house showings, especially when it's the same house every time.
Yeah.
Um,
Let's get this place rented.
yeah, right. I don't want to do this again. But when you get older, you start to realize, what it is your family is doing, and the incredible value that comes along with being a landlord, and all the rules and of engagement there as well. So it and the later part of my childhood certainly became very interesting. There's a lag time between when a property breaks ground and when the actual units are delivered to the market for rent. So everything that was delivered in 2024 started construction in 2022. That's when they broke ground, roughly. It was
Yeah.
about a 24-month lag. And that's when interest rates were low. Everyone thought this is going to keep going forever. Let's build as much as we can because the demand is insane, right? And so that's what happened. And now we're kind of feeling the effects of that. So now fast forward, we're in 2025 now, and we're still at a pretty high rate of deliveries. It's going to be a little bit lower than 2024, but still high. And then in 2026 and 2027, that's when deliveries are going to fall off cliff. Because if you think about the lag time, anything coming online in 26 and 27 was started in 24 and 25.
Yeah.
So interest rates are where they are. It's very difficult to pencil a deal at a 8% construction loan to get it out of the ground. So that's why basically the supply is going to shut off here.
Yeah.
But what's happening is we have 570 billion in debt coming due in 2025, and a little bit less than that in 2026. Those are the loans that people took out in 21 and 20, buying over leveraged distressed properties.
Yeah. Good rates that are now due to be repurposed into not good rates. That's the big deal, right?
That's the big deal, right?
Yeah.
I mean, so like 23 and 24, we did see some cracks of distressed properties, distressed debt coming due, and actually some of our team was able to take advantage of that, and so that's why we brought them on as our, in Riverly to make sure that, we have the experience to make it happen on the distressed debt side. Um, but that said, this next 6 months to a year is going to be the boom of distressed debt. So that's what we're looking at. What's going to happen after that? Um, well, like we said, 2026 and 27, the supply shuts off, right? But we are absorbing those units quickly, actually more quickly than people thought. Um, so as a country, obviously every market is different, but those units are going to get absorbed. And then in 2026, late 2026, 2027, rents will go up. It's just a factor of supply and demand. Um, Basically, housing supply doesn't wane or wax or wane. It just moves around, right? Or sorry, demand. I mean,
Yeah.
moves around. So depending on the market you're in and where you're at, that's those changes are going to happen.
As I was scrolling on your site, I just saw the target markets: Denver, Atlanta, Phoenix, and Dallas. It's interesting because even with what you mentioned, of all of those, Atlanta's the lowest priced one. So I think it's kind of an interesting corollary to the others because it's a big market, but price wise, it's not anywhere near, all of these other markets that we're talking about. So the what you could get there or the risk that you could take might be leveraged a little better in a market like that if they're oversupplied and the prices are just so much better compared to the other markets.
Yeah. No, it's amazing. I mean, we look at like upper class C and class B stuff is what we like.
Yeah.
We want to turn a B minus into a B plus or a C plus into a B minus. And Atlanta seems to be really well suited for that. There's like Colorado Springs, for example, is unfortunately built as mostly one bedrooms.
Yeah.
Most of the town is that way. Atlanta seems to be the opposite. So, we're definitely looking hard there. Actually, Seattle has shown a lot of promise as far as a lot of distressed debt. So, obviously there's markets we like based on the data,
Yeah.
but if the entry point is low enough in virtually any major market, obviously we're not going to buy something in rural South Carolina or something like that where there's just no people
Yeah.
because real estate doesn't work with no people. But if it's in the right market where we can turn it around and get in at the right entry point, then that's the deal we'll look at.
We've talked foreclosures a lot with, single family home buyers and people who trade in distressed small assets. But when you're buying an apartment building, I would think that the foreclosure process is just even, it's difficult for just a regular, a condo. What does that entail? And are you looking to avoid that and kind of just figure out what you can do with the property because with the debt, because you got a good deal?
Yeah, I mean, we will do whatever it takes. Every state is different as far
Yeah.
as foreclosure process. Some states takes 6 months, some states takes a month. Um, Texas is a great market for that. Florida is not. Colorado is tougher as well. So it just kind of depends on where you're at. Um, for us, it just comes down to having enough capital to be able to, you know, run the gambit and pay whatever it takes. A lot of times it does mean, going to probate court and figuring that whole process out. But we've got a pretty good track record with some of our guys on the team to make that happen.
Yeah, it also seems like purchasing the debt out right now is more complicated than just a traditional deal. So it's not going to appeal. There's not going to be the same amount of people in there to try to do it. Does that help you get leverage to get better deals on the debt?
Absolutely. Yeah. We're usually competing with 3 or 4 other groups
Yeah,
at the
yeah.
most. We're versus on a, marketed, multifamily deal, you're probably competing with 30 or 40.